What if you could buy a piece of some of the best businesses in the world? We're talking railroads, huge energy companies, iconic brands, for a price that seems, well, almost too good to be true. Today, we're going to peel back the layers of one of the most famous companies on the entire planet, Warren Buffett's Berkshire Hathaway. Okay, but before we dive in, a very important heads up. This is not financial advice, not at all. Think of this as a fun, educational thought experiment, just a different way to look at things. You should always do your own research, all right? Let's get into it. To get started, you have to understand that just looking at Berkshire Hathaway's official earnings report can feel like trying to solve a puzzle with a million moving pieces. It's confusing. I mean, just look at this total net earnings column. It's an absolute roller coaster. They make $96 billion one year, then they lose $22 billion the next, then they're back up with another massive gain. It's totally chaotic, and honestly, at first glance, it makes zero sense. So what is even going on here? Well, all that craziness comes from a weird accounting rule. It forces Berkshire to report paper gains and losses on its giant stock portfolio every single quarter, even if they haven't sold a single share. And get this, Buffett himself has basically told everyone, hey, just ignore that number. So here's the secret. The key to solving this puzzle is to stop looking at Berkshire as one giant, confusing company. You have to see it for what it really is. Three totally distinct businesses, all living under one roof. Okay, pillar number one, the public stock portfolio. This is basically a massive, expertly run investment fund. It's holding about $295 billion worth of stock in giants like Apple, Coca-Cola, and American Express. The great thing about this part is its value is totally transparent. We know exactly what it's worth every second the market is open. Easy. Next up, pillar two, the mountain of cash. And I mean, it is a mountain. Berkshire is sitting on an unbelievable pile of cash and U.S. treasuries, around $344 billion. Buffett famously calls this his elephant gun, just waiting for a huge opportunity to come along. And just like the stocks, this is a liquid asset with a very clear, easy-to-understand value. And that brings us to pillar number three. This is the real heart of the company, all the businesses Berkshire owns completely. We're talking about the BNSF Railway, Geico, Berkshire Hathaway Energy, See's Candies, the list goes on and on. Now, this is the hard-to-value core, the engine that just consistently churns out cash year after year. This is the part we really want to figure out. So how on earth do you put a price tag on this incredible collection of companies? Well, the clue, it turns out, is hidden in plain sight, right back in that confusing earnings report we started with. You just have to know where to look. Okay, check this out. On the left, you've got those wild, chaotic total earnings we talked about. But look over on the right, at the operating earnings. This is the actual cash profit being generated by those pillar three businesses. See that beautiful, steady climb from $22 billion in 2020 to an estimated $47 billion in 2024. That is the consistent, powerful engine we want to value. All right, now for the fun part. Since we have the real earnings number, let's do a little back-of-the-envelope math. We're going to figure out what price the market is actually putting on these amazing operating companies. So we'll start with Berkshire's total market value, which is around $1.02 trillion. From that, we're going to subtract the parts that have a clear price tag. So let's take out that $344 billion in cash, and then we'll subtract the $295 billion value of that stock portfolio. So, after we strip out the cash and the stocks, what are we left with? We're left with $381.3 billion. Just let that sink in for a second. This number is the implied price the market is currently paying for all of Berkshire's wholly owned businesses combined. The railroad, the energy companies, Geico, the whole shebang. Now, is that price cheap or is it expensive? How do we know? Well, to figure that out, we can use a really simple metric called the price-to-earnings ratio, or PE. We're just going to divide our implied price of $381.3 billion by a conservative estimate of $50 billion in annual operating earnings. And the result is just 7.6. That is a price-to-earnings ratio of 7.6. Now, to put that into perspective, the S&P 500, the biggest companies in the U.S., often trades at a PE of 20, sometimes even higher. So this first quick calculation suggests Berkshire's core businesses might be trading at a massive discount to the rest of the market. But you know what? Maybe that was a little too simple. Let's try this again, but with a more conservative calculation, just to be fair and make sure we're covering all our bases. See, a more thorough approach has to account for the company's liabilities. Berkshire has about $125 billion in debt, plus a deferred tax liability of around $50 billion. That's basically taxes they'll owe down the road. It's fair to say the operating businesses are responsible for those. So to get a truer value, we'll add those liabilities back to our implied price. So this gives us a new, more conservative value for those operating businesses of $556.3 billion. Now, when we divide that by our $50 billion in earnings, our new PE ratio comes out to 11.1, still a remarkably low number, even after we've accounted for all that debt and those future taxes. All right, there you have it. We've run the numbers two different ways, and both of them are pointing in a very similar direction. Let's put these side by side to really see the final picture. So by breaking Berkshire down and focusing on its real operating earnings, our little analysis shows the market seems to be valuing its incredible collection of companies at a PE ratio somewhere between 7.6 and 11.1. And even at the high end, a PE of 11 for such a high-quality and diverse group of businesses is, well, that's considered very attractive compared to the broader market average. It's just a powerful reminder that sometimes the true value of a company is hidden just beneath the surface of those confusing headline numbers. So the big question is this a hidden gem sitting in plain sight, or is there something really important that this simple analysis is missing?